Imagine buying a stock at $40 a share and watching it unexpectedly climb to $150. That $110 gain feels like a win you have to claim immediately. Standard financial advice tells you to sell and lock in that profit. This graph shows the result. The moment you click sell, your growth stops. Investors fall into this trap with companies like ExxonMobil every day, viewing a price spike as an exit signal rather than a sign of a healthy asset. When you cash out, you secure a lump sum that starts depleting the moment it hits your account. Without the asset, you have no engine to replace that money once it's spent. Most investors treat these wins as an exit point. By selling the asset for a one-time gain, you trade a permanent income stream for a single payout. You sold the goose. Now you have zero underlying assets and no ongoing cash flow. The machine that was creating your wealth has been dismantled for parts. Wealth is built by prioritizing the continuous income an asset generates over the temporary spikes in its market value. The amateur investor lives in a frantic cycle, constantly trying to time the market to buy low and sell high. Professionals play a different game. They acquire assets to build permanent, uninterruptible cash flow streams that pay them regardless of market sentiment. When gold prices spike, amateurs rush to buy physical bars, hoping to flip the metal for a quick profit before the price drops again. The professional ignores the price of the metal. Instead, they buy the company that pulls the gold out of the ground. They keep the mine even when prices are at all-time highs. This allows them to collect massive dividends from every single ounce the company sells. The mine is the goose, and the dividends are the eggs. Owning the engine of production is more efficient than trading its output. In a world of wartime investing, geopolitical conflict causes massive price swings and market uncertainty. Amateurs panic during these periods because their portfolio value fluctuates. Professionals use this chaos to increase their yield. This is income stacking. It's layering multiple revenue streams, like dividends, rent, and option premiums, onto a single underlying asset. Market panic drives up the cost of option premiums, pushing the total yield of your stack higher. Volatility makes your golden eggs bigger. Warren Buffett utilized this strategy with his major investments in Occidental Petroleum. He didn't buy in to flip the stock. He bought to capture the cash flow generated for as long as oil is in. If you hold the asset and stack your income, volatility becomes a tool for growth. To see the true impact, we have to project these strategies forward several decades and compare their outcomes. After 30 years, the amateur's capital is depleted. They are forced to keep hunting for the next hot stock just to maintain their lifestyle. The professional ends up with a self-sustaining portfolio that pays out 30% annually because they never sold the assets that generate that wealth. This principle is clearest in real estate. You wouldn't sell a rental property just because its market value tripled. You keep the building, raise the rent over time, and add services like laundry or vending machines to stack the income higher. In this model, the asset functions as the ultimate reward. You own it for the checks it sends, not as a placeholder for a sale. Stop focusing on market timing. Instead, look for assets that have a mechanical ability to produce cash flow, regardless of the share price. By focusing on stacking income streams rather than timing price shifts, you build a portfolio that produces generational wealth. Keep the goose and collect the eggs forever.